Every investor dreams of success. Everyone wants to grow wealth, achieve freedom, and live without financial worry. But in the real world, most people struggle to reach that goal. Why? Because they focus on shortcuts instead of principles. They chase trends instead of learning discipline. They look for quick profits instead of building lasting habits. True investment success is not about luck or timing. It is not about predicting the future or following every market expert. It is about mastering a few timeless rules and applying them consistently. These rules have guided the world's greatest investors for generations. They work in every country, in every market, and in every time period. They are simple to understand, but powerful when practiced with patience. You do not need to be a financial expert to follow these rules. You do not need to have a large amount of money to start. All you need is the right mindset, a little discipline, and the willingness to learn. The most successful investors are not the ones who make the most trades. They are the ones who make the best decisions and let time do the rest. This book brings you 10 clear and practical rules that will guide your investing journey. Each rule teaches you something deeper than numbers or market trends. You will learn how to think clearly, act wisely, and stay calm in every situation. You will discover how to avoid common mistakes that destroy wealth and how to build habits that create it. These 10 rules will show you that investing is not only about money, it is also about character. It is about patience, control, and understanding. When you invest with clarity and confidence, you gain more than financial growth. You gain peace of mind. Remember, success in investing is not a one-time event. It is a lifelong process of learning, adapting, and improving. The earlier you start, the stronger your foundation becomes. And the more consistent you remain, the greater your rewards will be. Each chapter in this journey will take you one step closer to mastering the art of investing. As you listen, keep an open mind. Reflect on your past decisions, your emotions, and your goals. You may recognize mistakes you have made or habits you want to change. That is good. Awareness is the first step toward improvement. By the end of this journey, you will not only understand how to invest better, but also how to think better. Because successful investing begins not with money, but with mindset. And the first rule, the one that shapes all others, is about thinking clearly. Let us begin with Rule 1. Think rationally. Rule 1. Think rationally. Investing begins in the mind. Before you buy a stock, a bond, or any asset, you must first make decisions clearly and calmly. Thinking rationally means not letting emotions like fear or greed drive your choices. It means evaluating information carefully and understanding the reasons behind every decision. Many investors lose money because they act based on impulse, panic, or the desire to follow the crowd. When the market is rising quickly, excitement can push people to buy without thinking. When the market falls, fear can make them sell in haste. Both reactions can harm long-term wealth growth. Rational thinking requires patience and perspective. Ask yourself, does this investment make sense in the long term? Do I understand the business or asset? Am I being influenced by hype or rumors? Take a step back before making any decision. Even experienced investors pause and review their reasoning before taking action. Another key part of thinking rationally is avoiding overconfidence. Just because a stock is performing well now does not mean it will continue to rise forever. Markets change, industries evolve, and unexpected events happen. Being rational means acknowledging uncertainty and making plans that account for it. Do not assume you have complete control or perfect knowledge. Instead, prepare for different outcomes and focus on decisions you can justify with logic. Rational thinking also involves using simple rules to guide your actions. For example, define the maximum risk you are willing to take on an investment. Decide in advance when to sell if things do not go as planned. Set clear goals and criteria for choosing investments. When your choices are based on clear rules rather than emotions, you can avoid costly mistakes. It is also important to ignore the noise. News headlines, social media posts, and market opinions can be overwhelming. Not every prediction or opinion is accurate or useful. Rational investors filter information carefully and focus on what truly matters: facts, trends, and fundamentals. Ask yourself whether each piece of information will affect your long-term success or just create unnecessary stress. Finally, thinking rationally means being consistent. Do not change your strategy with every market move. Stick to your principles and review them regularly. Learn from mistakes, but do not let a single setback lead to panic or rash decisions. Rational thinking builds the foundation for every other rule of investing. If you cannot make clear and logical decisions, it will be difficult to follow the remaining rules successfully. By mastering rational thinking, you prepare yourself to take advantage of opportunities while avoiding unnecessary risks. You develop confidence in your own decisions, which reduces stress and improves long-term results. Once you are able to think clearly and make rational choices, you are ready to move to the next essential rule: understanding what you are doing. Knowledge and clarity in your investments will multiply the power of rational thinking. Rule 2. Understand what you are doing. The second rule of investment success is to truly understand your investments. Never put your money into something you do not comprehend. Investing blindly is one of the fastest ways to lose wealth. Many people are attracted to opportunities that promise quick profits without taking the time to learn about them. They follow advice from others or chase trends without knowing the risks or mechanics involved. This approach often leads to mistakes and disappointment. Understanding what you are doing begins with knowledge. Take time to learn about the business, the asset, or the market before investing. If you are buying shares of a company, understand its products, services, customers, and competitors. If you are investing in real estate, know the location, market trends, and potential returns. Knowledge reduces uncertainty and allows you to make informed choices. Another key aspect is assessing the fundamentals. Ask yourself whether the investment has real value. Does the company earn profit consistently? Does the business have a strong competitive position? Are its finances healthy? If the answers are unclear, do not invest until you can verify them. Investing also requires recognizing your own limitations. It is impossible to know everything about every market or sector. Focus on areas where you have experience, understanding, or access to reliable information. This is often called your circle of competence. Staying within it reduces risk and increases the likelihood of success. Do not be tempted to invest in unfamiliar areas just because others are excited about them. Understanding your investments also means knowing the risks. Every opportunity has potential rewards and potential losses. Ask yourself, what could go wrong and how would I respond? Are there factors outside my control that could affect this investment? Knowing the risks allows you to prepare and make better decisions under pressure. Another important point is avoiding complexity. Some investment opportunities may seem complicated, with many rules or calculations. Do not assume complexity equals better returns. If you cannot explain how the investment works in simple terms, it is better to skip it. Simplicity often provides clarity, reduces mistakes, and increases your confidence. Learning before investing also builds discipline. Researching an investment carefully teaches patience and attention to detail. It prevents impulsive decisions and emotional reactions. Over time, this habit of understanding your actions creates a foundation for long-term success. Finally, understanding what you are doing connects directly to rational thinking. When you combine clear thought with deep knowledge, your decisions become much stronger. You are no longer guessing or relying on luck. You act with reason, knowledge, and confidence. Once you fully grasp your investments, you are ready to move to the third rule: learning constantly. Continuous learning will help you adapt, improve, and achieve greater success in investing. Rule 3. Learn constantly. The world of investing is always changing. New companies emerge, technologies evolve, and markets shift in ways that can be difficult to predict. To succeed, you must commit to learning every day. Investing is not a one-time activity or a short course that ends after a few weeks. It is a lifelong journey that rewards those who seek knowledge and adapt to change. Learning constantly means reading, listening, and observing. Read books by experienced investors. Watch educational videos and follow credible financial news. Take time to understand different markets, industries, and asset types. The more you know, the better decisions you can make. Knowledge reduces uncertainty and gives you confidence in your choices. Mistakes and failures are also teachers. Every investor, no matter how skilled, makes errors. The key is to study them carefully and understand why they happened. Did you act too quickly? Did you ignore warning signs? Did emotions influence your decision? Learning from these experiences turns setbacks into lessons and strengthens your skills for the future. Another important aspect of learning constantly is observing others. Successful investors often share their experiences, strategies, and insights. Pay attention to what works for them and how they think. Do not copy blindly, but adapt useful lessons to your own situation. Every new perspective expands your understanding and helps you make smarter choices. Learning also means updating your knowledge regularly. Markets change, regulations evolve, and new investment opportunities arise. What worked last year may not work today. Stay curious and open-minded, and avoid assuming that past success guarantees future results. Investing is a field where continuous learning is not optional. It is essential. Patience is closely connected to learning. Take time to study before acting. Avoid rushing into investments without understanding the details. Slow, thoughtful learning produces better outcomes than impulsive decisions. Over time, your knowledge accumulates, giving you a clear advantage over those who act without preparation. Continuous learning also helps you build discipline. When you research thoroughly, follow your principles, and track your progress, you develop habits that support long-term success. This discipline prevents emotional reactions and keeps you focused on your goals. The combination of knowledge and discipline is a powerful foundation for wealth growth. Finally, learning constantly connects to every other rule of investing. Rational thinking improves when it is informed by knowledge. Understanding what you are doing becomes easier with experience and study. Patience is strengthened when you know the reasons behind your choices. By committing to lifelong learning, you prepare yourself to face uncertainty, adapt to change, and make smart decisions consistently. Once you embrace learning as a daily practice, you are ready to move to the fourth rule: being patient. Patience is the bridge between knowledge and long-term success in investing. It allows your decisions to mature and your wealth to grow steadily. Rule 4. Be patient. Patience is one of the most powerful tools an investor can have. Many people want quick results and expect their investments to grow overnight. This expectation often leads to disappointment and poor decisions. Wealth is not built in days or weeks. It grows steadily over months and years when investments are chosen wisely and allowed to develop. Being patient means resisting the urge to react to every market movement. Markets rise and fall, sometimes dramatically. News headlines and social media posts can create fear or excitement that tempts investors to act impulsively. A patient investor understands that short-term fluctuations are normal and rarely indicate permanent problems. Instead of reacting emotionally, they focus on the long-term potential of their investments. Patience also requires trust in your research and strategy. If you have studied an investment carefully, understand its value, and have a clear plan, you must give it time to succeed. Constantly checking the market or selling at the first sign of a dip can prevent your money from growing. Patience allows compounding to work its magic, turning small gains into substantial wealth over time. Another aspect of patience is the ability to wait for the right opportunity. Not every investment is a good investment. It is better to wait for a high-quality opportunity than to rush into something mediocre. Timing is not about predicting the market perfectly. It is about acting when the risk and reward align in your favor. This discipline separates successful investors from those who chase every trend. Patience also helps you maintain emotional control. When you are not worried about immediate results, you make decisions more calmly and rationally. You are less likely to panic during market downturns or become overconfident during upswings. This calm approach reduces mistakes and increases the chances of long-term success. Furthermore, patience teaches humility. Markets do not always follow expectations, and outcomes are not guaranteed. By waiting and observing, you learn to accept uncertainty and make thoughtful choices. Patience encourages careful planning and discourages impulsive behavior that can destroy wealth. It is important to remember that patience works hand in hand with other investment rules. Rational thinking helps you resist emotional reactions. Understanding what you are doing allows you to trust your choices. Continuous learning helps you identify when patience is required and when action is necessary. Together, these skills create a strong foundation for wealth building. Finally, patience is not passive. It does not mean ignoring your investments or doing nothing. It means observing, reviewing, and making informed adjustments when necessary. It means giving your investments the time they need to grow while avoiding unnecessary interference. By embracing patience, you allow your financial decisions to mature. You reduce risk, increase stability, and create the conditions for long-term success. Once you master patience, you are ready to move to the fifth rule: avoiding stupidity. This rule focuses on recognizing and preventing the simple mistakes that can derail your progress. Rule 5. Avoid stupidity. The fifth rule of investment success is deceptively simple. Avoid stupidity. While it may sound obvious, many investors fail not because they take risks, but because they make unnecessary mistakes. Avoiding stupidity is about recognizing the pitfalls that can destroy wealth and taking active steps to prevent them. It is not about seeking extraordinary opportunities or extraordinary gains. It is about not doing things that are clearly harmful to your financial health. One common source of mistakes is following the crowd. Many people invest in popular trends, hot tips, or fads without understanding the risks. When everyone is excited about a new stock or asset, emotions run high, and rational thinking often disappears. If you act only because others are acting, you may buy at the top and sell at the bottom. Avoiding this type of mistake requires discipline and careful evaluation. Always ask, do I understand this investment, and does it fit my plan? Or am I being influenced by hype? Another form of stupidity is neglecting basic research. Investors sometimes rely solely on the opinions of others, or make assumptions without verifying facts. Failing to check fundamentals, finances, and market conditions can lead to serious losses. Take the time to understand the risks, potential returns, and key factors that affect an investment. Knowledge and preparation reduce the chance of careless mistakes. Debt is another area where stupidity can destroy wealth. Borrowing excessively to invest or living beyond your means creates unnecessary risk. High-interest debt can quickly outweigh the returns on your investments. Avoiding financial overreach is essential. Live within your means, save consistently, and use leverage carefully, if at all. Impulsiveness is also a dangerous trap. Making decisions based on fear, greed, or impatience often leads to regret. The market will always offer opportunities, but not all of them are worth taking. Pause, reflect, and analyze before acting. Stupid mistakes often happen in moments of haste or overconfidence. Another form of stupidity is ignoring warning signs. Every investment carries risks, and signs of trouble often appear before losses occur. Ignoring red flags in financial reports, market trends, or company performance can be costly. Develop the habit of monitoring your investments and recognizing when changes may be needed. Proactive awareness prevents small problems from turning into large disasters. Overcomplicating investments can also be foolish. Some investors create complex strategies with multiple moving parts, thinking this will increase returns. Complexity often leads to confusion, mistakes, and poor execution. A simple, well-understood strategy is usually more effective and easier to manage. Finally, avoid letting ego influence your decisions. Pride can prevent you from admitting mistakes, asking questions, or learning from others. Humility and the willingness to accept that you do not know everything are key to avoiding errors. Recognize your limits and seek advice or knowledge when necessary. Avoiding stupidity is the foundation of all other rules. Even with patience, knowledge, and rational thinking, one careless mistake can undo years of progress. By identifying potential errors, Preparing thoroughly and acting with discipline, you protect your wealth and increase your chances of long-term success. Once you master the skill of avoiding stupidity, you are ready to move to the sixth rule: thinking long-term. Long-term thinking allows you to build lasting wealth while minimizing unnecessary risks. It is the bridge between disciplined behavior and meaningful results in investing. Rule 6. Think long-term. The sixth rule of investment success is to think long-term. Many investors focus on short-term gains, trying to make quick profits from market movements. This approach often leads to stress, mistakes, and lower returns over time. True wealth comes from holding quality investments over years, even decades, and allowing them to grow steadily. Thinking long-term means ignoring short-term noise. Stock prices, market fluctuations, and headlines can create fear or excitement, but they do not always reflect the true value of your investments. A patient, long-term perspective allows you to focus on the fundamentals rather than temporary changes. It reduces emotional reactions and prevents you from making impulsive decisions that could harm your portfolio. Another key aspect of long-term thinking is focusing on durable advantages. Invest in businesses, assets, or projects that have strong fundamentals and the ability to perform well over time. Look for companies with consistent earnings, reliable management, and products or services that remain in demand. Long-term thinking requires identifying these qualities and trusting that they will create growth gradually. Compounding is the magic of long-term investing. When you hold investments for extended periods, the returns begin to grow on themselves. Dividends, interest, and reinvested gains accumulate, creating a snowball effect. The longer you hold, the more powerful compounding becomes. This is why patience and long-term thinking work hand in hand. Thinking long-term also helps you make better decisions during market downturns. When prices fall, a short-term investor might panic and sell at a loss. A long-term investor sees an opportunity to buy quality assets at lower prices. Understanding the difference between short-term volatility and long-term value is essential. Another benefit of long-term thinking is reduced stress. You do not need to constantly monitor the market or react to every fluctuation. By keeping your focus on your goals and the big picture, you can remain calm and confident. This mindset allows you to enjoy the journey of investing rather than being trapped in anxiety and doubt. Long-term thinking also encourages planning. Set clear financial goals and align your investments with them. Consider how much you need for retirement, major purchases, or financial independence. Plan your strategy around these goals and use long-term thinking to guide your decisions. Finally, thinking long-term connects to all previous rules. Rational thinking helps you assess the real value of investments. Understanding what you are doing ensures you choose assets that can grow over time. Continuous learning allows you to adjust your strategy while remaining focused on your long-term plan. Avoiding stupidity prevents decisions that could derail your progress. By embracing long-term thinking, you create a mindset that prioritizes sustainable growth over quick wins. It allows you to make thoughtful choices, reduce risk, and maximize the power of compounding. Once you adopt this perspective, you are ready to move to the seventh rule: focusing on quality. Quality investments form the foundation for consistent long-term success. Rule 7. Focus on quality. The seventh rule of investment success is to focus on quality. Not all investments are created equal, and choosing high-quality assets is essential for long-term success. Quality is more important than quantity, and it often outweighs short-term gains or hype. A few strong investments can produce better results than many mediocre ones. Quality begins with strong fundamentals. If you are investing in a company, look at its earnings, balance sheet, and management. A financially stable company with consistent profits and responsible leadership is more likely to withstand market ups and downs. Similarly, in other investments, such as real estate or funds, assess the reliability, track record, and potential for growth. Quality investments provide a solid foundation that reduces risk and increases the probability of lasting success. Another aspect of quality is durability. Ask yourself whether the business, asset, or investment can survive challenges and changes over time? Does it have a competitive advantage or a moat that protects it from competitors? Will it remain relevant in the future? Investing in durable, high-quality opportunities ensures that your wealth grows steadily, rather than fluctuating wildly. Quality also reduces stress. When you invest in reliable assets, you are less likely to panic during market downturns. You can trust that your investments have strong foundations and are likely to recover and grow over time. This confidence allows you to stay patient, think rationally, and stick to your long-term plan. Another key point is that quality often requires paying more upfront. High-quality investments may seem expensive compared to risky or trendy options, but their long-term potential justifies the cost. Do not focus solely on short-term bargains or the cheapest options. A quality investment, even if it costs more initially, can produce much greater returns over the years. Focusing on quality also means avoiding unnecessary complexity. High-quality investments are usually understandable and transparent. You should be able to explain why you are investing in them and how they work. If something is too complicated or unclear, it may not be worth the risk, no matter how promising it appears. Another aspect of quality is management and leadership. For businesses, competent and ethical leaders make a huge difference in long-term success. They make wise decisions, handle challenges effectively, and ensure sustainable growth. In any investment, strong leadership or management ensures that your money is in capable hands. Finally, focusing on quality complements the other rules. Rational thinking helps you identify truly valuable investments. Understanding what you are doing ensures you evaluate quality correctly. Long-term thinking allows quality investments to grow and compound over time. Avoiding stupidity prevents you from settling for poor choices. By prioritizing quality, you build a strong, resilient portfolio that can withstand uncertainty and deliver consistent results. Once you master the skill of focusing on quality, you are ready to move to the 8th rule: controlling your emotions. Emotional control ensures that even high-quality investments are managed wisely and patiently. Rule 8. Control your emotions. The 8th rule of investment success is to control your emotions. Emotions are powerful, and when they influence your investment decisions, they can lead to costly mistakes. Fear and greed are the most common emotions that affect investors. Fear can make you sell prematurely, panic during market downturns, or avoid good opportunities. Greed can push you to chase risky trends, overpay for assets, or make impulsive decisions in the hope of quick gains. Controlling emotions begins with self-awareness. Recognize how you feel when markets fluctuate, when investments rise or fall, or when news is alarming. Be honest with yourself about your reactions. Once you understand your emotional tendencies, you can take steps to manage them effectively. Another key to emotional control is planning. Set clear rules for buying, holding, and selling investments. Define in advance how much risk you are willing to take, when to exit an investment, and what goals you aim to achieve. When decisions are guided by a plan rather than feelings, you are less likely to act impulsively. Patience and emotional control are closely connected. When you allow time for investments to grow, you avoid knee-jerk reactions to short-term fluctuations. Long-term thinking provides perspective and reduces the emotional impact of temporary setbacks. A patient investor does not panic when the market dips or become euphoric when prices rise rapidly. Education is also crucial for managing emotions. Understanding your investments, the market, and the principles of investing reduces anxiety. Knowledge creates confidence, and confidence calms emotional reactions. When you know why you are investing and how your investments work, you are less likely to be swayed by fear, rumors, or hype. It is also important to maintain a balanced mindset. Investing is not a game of winning every time. Losses are part of the journey, and understanding this helps you avoid emotional extremes. Celebrate successes, but do not let them make you overconfident. Acknowledge mistakes, but do not let them paralyze you with fear. Maintaining equilibrium allows you to make rational and consistent decisions. Emotional control includes avoiding comparison with others. Many investors feel pressure when they see others making large profits or appearing successful. Comparing your progress to others can lead to envy, impatience, or reckless decisions. Focus on your own strategy, goals, and results. Your investment journey is unique, and controlling emotions requires staying true to your own plan. Another aspect of emotional control is avoiding overreaction to news. Financial media often exaggerates events, creating panic or excitement. Do not make decisions based solely on headlines or market gossip. Filter information carefully, analyze it logically, and act only when it aligns with your plan. Finally, controlling your emotions strengthens all other rules. Rational thinking is ineffective if emotions override logic. Understanding your investments is wasted if fear or greed causes irrational decisions. Patience is impossible without emotional discipline. Even high-quality investments can suffer if emotions drive poor timing or overconfidence. By mastering emotional control, you become a calmer, more rational, and more successful investor. You make decisions based on analysis, not impulse, and you navigate market volatility with confidence. Once you achieve emotional discipline, you are ready to move to the 9th rule: learning from mistakes. Mistakes are inevitable, but controlling your emotions allows you to learn from them and grow stronger. Rule 9: learn from mistakes. The 9th rule of investment success is to learn from mistakes. Every investor, no matter how experienced, makes errors. Mistakes are not failures if you take the time to understand them and use them as lessons. Ignoring mistakes or repeating them is one of the fastest ways to lose wealth. Learning from mistakes begins with honesty. Acknowledge when a decision went wrong and identify the reasons. Did you act too quickly? Did you ignore warning signs? Did emotions like fear or greed influence your choice? Being honest about your errors is the first step toward improving your skills. Another key is reflection. After every mistake, review the situation carefully. Write down what happened, what you learned, and how you can avoid the same problem in the future. This practice helps create a record of lessons that you can refer to when making new decisions. Over time, these reflections build wisdom and improve your judgment. Mistakes also teach humility. Investing can be unpredictable, and even the most rational, knowledgeable, and careful investor will sometimes be wrong. Accepting that you do not know everything allows you to stay open-minded and continue learning. Humility prevents overconfidence, which is a common cause of repeated errors. Another important aspect is adaptation. Once you understand a mistake, adjust your strategy to prevent it from happening again. This may involve changing your approach to research, improving risk management, or setting clearer rules. Adaptation turns mistakes into tools for long-term growth. It is also crucial not to dwell on mistakes emotionally. Regret, guilt, or fear can paralyze you and lead to further errors. Accept that mistakes are part of the investing journey and focus on what you can do differently next time. A calm, rational mindset allows you to learn efficiently and move forward. Learning from mistakes also involves studying the experiences of others. Many investors share stories of losses and lessons learned. By observing these cases, you can avoid pitfalls without having to experience them firsthand. Mentorship, books, and credible sources provide valuable insights that accelerate your growth. Finally, integrating mistakes into your learning process strengthens all other rules. Rational thinking improves as you analyze errors objectively. Understanding your investments deepens as you recognize what went wrong. Patience and long-term thinking are reinforced when you see the cost of impulsive actions. Emotional control becomes easier when you approach errors as lessons rather than disasters. By embracing mistakes as opportunities to learn, you create a cycle of continuous improvement. Each lesson makes you a wiser, more disciplined, and more successful investor. Once you have learned from your mistakes, you are ready to move to the 10th and final rule: keeping life simple. Rule 10. Keep life simple. The 10th rule of investment success is to keep life simple. Simplicity is a principle that applies to every aspect of investing and personal finance. Complex strategies, excessive tools, or unnecessary actions can create confusion, stress, and mistakes. A simple, clear approach allows you to focus on what truly matters and make better decisions consistently. Keeping life simple begins with clarity in your goals. Define what you want to achieve with your investments. Are you saving for retirement, buying a home, or building long-term wealth? When your objectives are clear, it is easier to choose the right investments and avoid distractions. Another aspect of simplicity is focusing on a few high-quality opportunities. Do not try to invest in every trend or market. A small number of well-researched, high-quality investments often produce better results than a large, scattered portfolio. Concentration in quality allows you to monitor your investments effectively and make thoughtful decisions. Simplicity also means avoiding overcomplication in your strategies. Complex financial instruments, frequent trading, or intricate plans can increase risk and reduce your ability to act rationally. Stick to strategies you understand and can manage comfortably. If you cannot explain your investment in simple terms, it may not be the right choice for you. Another important aspect is minimizing unnecessary financial stress. Live within your means, avoid excessive debt, and manage expenses wisely. When your finances are simple and organized, you reduce the chances of mistakes and create room for your investments to grow. A simple lifestyle also supports patience, emotional control, and rational thinking. Simplicity extends to decision-making processes. Create clear rules for buying, selling, and managing risk. Follow these rules consistently, rather than making impulsive decisions. Having a system reduces mental strain and keeps you focused on long-term goals. Keeping life simple also helps you stay disciplined. Discipline is easier to maintain when you do not have too many distractions or overly complicated plans. A simple, consistent approach allows habits to form, such as saving regularly, reviewing investments, and learning continuously. Over time, these habits compound into significant results. Finally, simplicity enhances all other rules. Rational thinking becomes clearer when there is no clutter. Understanding your investments is easier when you focus on quality and avoid complexity. Patience and long-term thinking are more effective when your plan is straightforward. Emotional control improves when decisions are based on a simple, logical framework. Even learning from mistakes is more productive when your approach is clear and uncomplicated. By keeping life simple, you create a solid foundation for lasting success in investing and in life. Simplicity allows you to focus on what matters, act with confidence, and achieve your financial goals without unnecessary stress. When combined with all the other rules, simplicity completes the framework for smart, disciplined, and effective investing.